Hi everyone, welcome back to my channel. Yesterday, Friday, June 24th, 2022 was another incredible trading day with the continuation of a short-term bull rally we've been seeing. I wanted to take some time to review the chart for the NASDAQ, which is the same chart as QQQ, because the amount of the advanced price action and volume price analysis concepts it demonstrated in one day of trading was incredible. It's not very often we see so many concepts appear on one chart, so I wanted to call out each of them in an effort to help us as traders in the event we see any of these pop up again, which we most certainly will. Before we get started, if you would like to get a 10% discount for Trade Addicts, don't forget to use my referral link in the description. You'll also find referral links for TradingView and Top Step funded trader programs that will give us both discounts. Lastly, if you enjoy this content, don't forget to like and subscribe to help me grow this channel. So I'm very excited about the concepts I'm about to show you, and with all that being said, let's get right into it. So the first thing I look at every day, every week, is the upcoming macroeconomic events, which you can see here. The big one that stood out to me was the 5-year inflation expectations. So I already knew come 10 a.m. I was going to step out of the market. Now, there was a specific play I could have taken, which I'll talk about, but also in hindsight, there were some indicators that the Fed was going to be dovish on these expectations, which should have helped me potentially stay in the market, but it's still, in my mind, gambling if you choose to hold positions through these macroeconomic events, because if you are wrong, they can go against you in a big way and just completely wreck your day. So I already knew that this was going to stand out of my mind going into the day. Of course, it wasn't going to prevent me from taking trades beforehand, especially if we got good movement. Just at 10 a.m. when the news was coming out, I wanted to make sure I wasn't holding any open positions, especially on my futures account. So the other thing I did, of course, is the higher time frame analysis, which I've discussed in other videos, so I don't want to go too far into it here, but I like to use the daily and the 30-minute personally. And on the daily chart, I'm just using standard price action with looking at, and also looking at the volume. Like, as you can see, we had this large divergent candle today, which is something standing out to me now. But prior to that, it did look like that this trend would continue, this uptrend would continue, because we do see increasing volume as it moves up. Now today we get a big candle on lower volume, which tells me that this rally might be coming to an end soon, especially if we get more of these. But then also at certain price points, I have my support and resistance lines. I also like to use the 30-minute with the volume profile on, because the value area high, value area low, and POC points, along with these high volume nodes, which I went into great detail in another volume price analysis series where I particularly covered volume profile. And so if you're interested in knowing how I derive these levels, definitely check that video out, because it will help you tremendously. But so I wanted to just get my basic levels on there. I like keeping my chart clean, which we'll get into more, so I didn't want to put too much, just levels that I was concerned with that would most likely come into play as the trading day went on. So concept number 3 here is going to be my pre-market assessment. And with this, the one thing I'm looking at is what happened in the pre-market. So you can see these levels that I noted from the daily and the 30-minute chart are indeed coming to play. It looks like we're in an uptrend, and the rectangles I have here are showing volume gaps, which actually end up acting as support and resistance zones. So we can see from the open, we never dropped below this area, hence the reason why I don't have any volume showing here, because this volume profile I'm demonstrating in this video is for the daily session. So in futures, that's the 6 p.m. to 5 p.m. session. Now, if you're not doing futures, if you're doing SPY or QQQ, you can still use this volume profile, and you don't get as much insight into what's going on, and that's why it's always nice to take a peek at futures with whatever charting software you're using, just to get that deeper insight. However, you can still see that we're in an uptrend, and then after a move upwards, we just essentially started consolidating, and it created this high volume node here. And so the question is, are we going to break through this volume gap that was created above, or are we going to hold this volume gap that was created below? So that's the first thing I'm looking at. So when the market opens up, we could see that we actually held the volume gap that was created below, and we immediately start moving up. And we start getting higher volume. So now it's worth noting that this volume profile did not look like this, right? It develops throughout the day, but what does indeed happen is, for instance, on our very first, what would be considered a pivot here, because we get this doji candle. If you're looking at the 1 minute time frame, it's going to be even more clear. This is the 3 minute time frame, which I should know. But you can see we get some consolidation in this area, which clearly shows us this low volume gap right here has now become our support. If you intend to take a position in this area, the goal is to try to get as close to this volume gap as possible, which if you're marketing in on a big move might not always be possible. But the thing to keep in mind is that your stop loss should be at the bottom of this volume gap, which is how I like to take my entries and exits. Now, what I would normally do, and this is actually where I took my first position when we had this big breakthrough and then we start consolidating and we see this volume gap forming, I got in here. Now, under normal circumstances, as we moved up, I would take some off at the top of the volume gap here, and then I would leave some runners, and I would basically at least leave one runner position until we see a market structure break. However, I circled 10 a.m. here because of the macroeconomic news that we saw before. So even though I did leave a runner as we moved up through, and you could see there's low volume gap that we just completely blew through, which at the time wasn't present at all. It was just unknown territory. But I did have a level from the higher time frame. So I knew, okay, getting above this level is a big deal. If we break and rebase on that level, I could stay in my position. And it turns out perfectly. So the level lines up with volume profile perfectly. And as we hold that level, this is actually a great chance to add positions on. Now, I chose to exit everything. And the reason being, again, was that macroeconomic news. I do not like to gamble because you could see we ended up getting good news and it shot up. I mean, it shot up 100 points in one 3 minute candle. Now, if it had been bad, it would have shot down 100 points. And even if you have a stop loss, which I would have had a stop loss below this at the bottom of this area that I'm showing you here, this volume profile gap. My stop loss would have been at the bottom here, especially in new positions that I just added. However, when it's that dramatic of a move that fast, your stop loss does not always exit at the price you set. It can exit, there's slippage that occurs when it's moving that fast, and you can get a much worse exit than you intended. It's the same deal if you try to market in. You can get a much worse entry than you intended if you try to market in during a big move like that. So if I did want to play this, and I wish I had thought about it sooner, I really should have done it, big regret of mine, the best move would have been to do a long straddle right in this area when we're consolidating and do some calls to the upside and some puts to the downside, and basically when the news breaks we get a volatile move and then you just close out the losing position. So essentially you get this big move up, you just close those puts that you bought and you let those calls run. So that would have been a way to play this on QQQ. It was such a dramatic move, it would have paid. Now I'm speculating here because I did not check the options chain. I do not know what IV was at, and that is a big factor. Whenever there's big news coming up, the market does account for that in terms of Vega and IV on your options Greeks, and therefore if the IV is spiked, then after this big move happens, you get the IV drops down tremendously and you lose money based on whatever the Vega is for that contract that you picked. So sometimes if the move isn't volatile enough, you can actually lose money on these straddles. If the move isn't big enough, and the two things would be whatever strikes you picked as well as the IV crush that occurs, which I'll have to get into another time if you're not familiar with that concept. But that would probably be the best way to play these big macroeconomic events. But you could see here the Fed announced good news, and then we immediately push higher. Now, so unfortunately, I didn't get to ride this big move up, but I did catch a nice big move on at this point. And so getting into concept number 5 is after we had this big move up, we had this what I call a weak market structure break. And why do I say it's a weak market structure? Well, you could see even from the pre-market, we've been in an uptrend where we've been making, despite the consolidation, when we are moving, we're making higher lows and higher highs, higher lows and higher highs. However, at this point, we come down, right? Still higher low, but then we make a lower high. Now, the reason I say it's a weak market structure break is because if it was a strong market structure break, we would have, at least on the next move, if not on this move, we would have either made a lower low beyond this point, or on the next pivot made a lower low, at which point we never did. So that tells me, yes, market structure changed. This is a great time to exit your runners when you see this starting to happen. Now, at that point, if you did have runners on it, like I said, I was already out because of the market news, but when we see this happen, market structure has changed. But whenever we have a weak market structure break, this brings me into the next concept I want to discuss, which is the ABC pattern. Now, this is purely a price action concept and is one of the best price action concepts I've ever learned about, and I hope that this helps other traders out there. But when we see these market structure breaks coming off these big volatile moves and they're weak like this, that usually tells us that there's probably going to be some sort of resume of the trend. And what happens here is what happens so frequently is called an ABC pattern. So we get our initial move down, then we get a lower high followed by another move lower, so a lower low, and that's the ABC, and then trend resumes. Now, I want to note here, and I'll get into this in another slide here, but you can see we're also where we bottom out, the volume profile kind of shows us that. But when you see this ABC pattern, you don't just want to assume, okay, the trend's going to resume, because we don't know. So the proper way to play that is to wait for the price to break above the high of point B, and you can see we get a break and we rebase. And actually you can see this low volume gap right here. So when we came up here, we had a bunch of volume come in, which created this high volume node to the right. And then as we consolidated, we have another high volume node area to the right, and there's this gap in here. And you can actually see this gap was previously resistance. So this was the resistance right above point B. And then when we break above it and we actually start consolidating slightly above it, we're actually getting, that's called a breaker block. And all a breaker block is when what was previously resistance becomes support, or vice versa, which was previously support becomes resistance. But the resistance that we see at point B becomes support, and we start basing off of that. And when you see this on an ABC pattern where the trend resumes and we start breaking and basing above point B of that ABC pattern, that is a fantastic sign that the trend is going to continue, and it means open positions. And of course, if you were to open your positions here, what I like to do is I like to set a limit order at the top of the volume gap and a stop loss at the bottom of the volume gap. And you can see that I would have stayed in that position the whole time until it ended up moving higher. And it's just incredible. These ABC patterns are very powerful. They happen all the time, and I really wanted to call that out because this was a perfect example of it. And it happens on all time frames too, I should know. So the next thing, which I've been sort of alluding to here, is the low volume node areas, which essentially the way this works is as we consolidate somewhere, we create a high volume node area. Then when we break through that, we typically will rebase right at the low volume node area. And this is where, this is where you actually want to get into your positions, right? And what I like to do is set limit orders right around that zone, enter my positions, and set my stop loss at the bottom of the zone. And then what happens is so if I entered here at the base of this zone, I would actually take some off as we got to the top of this high volume zone, but I wouldn't take all of it off. Then I like to leave runners and essentially rinse and repeat. So we do end up getting through the next volume gap in this scenario. We rebase again at the low volume node gap, and then we move higher. This again, if the market macroeconomic news wasn't in play, I would have 100% added more positions here. Now we get a big move higher, and then when we start seeing the market structure break, where we're making lower highs and then eventually lower lows, that's the point where it's time to get out of any runners that you leave on. But I want to show how this consolidation point becomes a high volume node area, and then you have a volume gap, a low volume node area, which actually becomes the support that we see hold us up for this trend shift right after the ABC pattern that we just reviewed. And then when we get above the next volume gap, we consolidate for a while, but that low volume node gap here ends up becoming our next support zone number 4. And then it's also worth noting that what would be zone number 5 was, you could see it was resistance at some point with this low volume node gap. And then when we broke through it, as we just discussed with the ABC pattern, it became support. So we had a breaker block zone here. And then as we consolidate here, and we ended up moving higher into uncharted territory, because we only are going to have volume plotted here for in our volume profile for where price has already been. So we're trading into the unknown. So at this point, when you start getting to the top of this previous high, this is where you actually, it's a good idea to take some positions off and leave some runners. And then right away you can see we get to the top and we rebase in this previous low volume node gap that was the high of day resistance, now becomes a support zone for us. And again, now this is going into the end of the day, so I wouldn't recommend putting on any positions. Honestly, when you see this is at close of day, when you see this pattern form, this would be a good time to get out. But I just want to show how you can use these low volume nodes and high volume nodes as your entry and exit points and stop loss points without ever having to draw support or resistance or rectangles. You can keep your chart super clean and take limit entries at the top of gaps. If it's an uptrend, limit entries at the top of the gaps, stop loss would be the bottom of the gaps. And then sort of the same thing where, and you never want to chase into one of these volume gaps. You want to be getting in at the support zone and then leaving runners to take you through the next, and then getting in at the support zone and leaving runners to take you through the next. And then when we have a market structure break like so, that's when you exit your runners. And then when the uptrend resumes and we get confirmation that we're now making higher highs, or excuse me, higher lows again, then at that point you could start using these volume gaps to start building up your positions once again, for ideally what would be the move higher, where you take some off and then leave your runners through, build up positions again, take some off, leave your runners through, build up positions again, and you get the idea. So these volume gaps, I mean, they always play out beautifully. They act as support and resistance zones. I highly recommend using them. Again, I did a whole volume video on volume profiles, so we'll move on from here. Now, the next concept I want to talk about, concept number 8, is the market net flow and how it helped me with this. So all day I'm flipping back and forth. I'm watching ES, I'm watching NQ, or in many people's cases SPY and QQQ, because those are the two that I like to trade. I also like to trade IWM, or RTY would be the futures ticker, M2K for micros. But anyway, I'm watching market net flow as a big part of my market awareness. And at the start of the day, we had huge confirmation that the uptrend that we saw was going to occur, because we can just see puts are just diminishing rapidly and calls market-wide are just rapidly increasing. And keep in mind, this is every ticker with the exception of ETFs, the cumulative flow for the day that we're looking at. And you can set that to 2-day, 3-day, 5-day. If you look at 2-day, it's actually even more amazing how you can see how bullish everything was at the open of the day. And then what happens at some point, which we just went through here on this downtrend, we can see that flow starts to die down. Now, ES or SPY did not have as dramatic as a move down as NQ exhibited, and that would be because of what the differences in the holdings that each of these ETFs and represent the underlying equities in the NASDAQ versus the S&P 500. But we start seeing this downtrend and we start seeing puts going up again, and sure enough, it correlates with this downtrend that we're seeing. So that's extra confirmation. Okay, if you had runners on at this point, time to get out. Now, I would not consider opening shorts on a day like this in the event that calls are still above puts, so we haven't had a cross like the one we see here, but also it was a weak market structure break. Remember, yes, we made lower lows here, but we never actually broke the initial this pivot point. Until we actually broke this pivot point over here, I would not considering open puts or shorts. You can if you're a more aggressive trader. Obviously, you could have made money doing so. It just personally, I would not have done so. And so we get our bearish confirmation here, and then what happens is everything just goes flat. and we could see calls and puts are just sideways for a while, and that corresponds with this consolidation point that we see here. Now we are basing on this support level, and we did resume the uptrend after the ABC pattern, so there is a case here to start building a position, but it's the sort of thing where we should keep it light because we don't know where this is going to go. And then finally, at the end of the day, we start seeing this big massive spike again, and then sure enough, it correlates with this big massive spike. So any positions that you were building after this resistance became support here would have really paid off, especially when you start seeing this confirmation, which is a great thing to see if you're watching market net flow and you've been building a long position. And then of course you can just hold it into the end of the day. So that's how I was using market net flow, and how I always use market net flow to help me determine if we have bullish confirmation, bearish confirmation, flat market, or as you can see, it resuming the previous trend. So, and then the one thing I also want to get into, and I did a whole series on volume price analysis, but just want to talk about how it played a major part here, and how this obviously could have helped me determine that, okay, the market's anticipating the macroeconomic news to be good, and so maybe I could have held on to my positions. But despite that, you could see we get a big high volume move up, and then we could see on the area where we're consolidating, the volume is lower, which is a good confirmation that we're going to continue the move, at which point we do. And then once again, when we're pivoting here, we get this pivot confirmation where volume's diminishing. Then we get our big high volume move up. And now when the downtrend starts, this is really interesting, because you could see this entire downtrend, it's kind of just like a big pivot, because volume is diminishing. And then when we see the volume spike, this is what we call stopping volume. So even though it happened on a bearish candle, which was a bigger candle, the volume was the candle was not significantly bigger than the previous candles, but the volume was. And that tells us that, and you could see even on the follow-up candle, that something is stopping us up here. And of course it corresponds with the volume gap, the support gaps, the support zones that we talked about earlier. And then all of a sudden we get a lower high, trend starts to break, we get these bull hammer candles, then now we make a higher high. I wrote bear hammers here, but I actually meant to say bull hammers. That's a typo, so please excuse that. But we could see here that the bull hammer candles are forming as we continue to make it, and then every time that we start coming down into these volume gaps, we see volume spike up, confirming that these volume gaps are going to hold. And these are great times to take limit entries here, and again start building your position. And then when we blow through, once again, we can see when we come to the volume gap, we get a bull hammer confirmation. And then lastly, when we run, we get a trend confirmation, because volume increases alongside of our uptrend until the day closes out. So that is everything I have for you today. I know I just threw a ton at you. Feel free to ask any questions you could do so in the comments or on Twitter, or however you'd like. I'd be more than happy to help, and I'll try to keep covering these advanced price action and volume price analysis concepts as they come up. There's so much other stuff I want to cover, so definitely subscribe and hit notifications in your interest. I'm going to talk about soon the benefits of future trading, as well as I want to get into like just more of the market structure stuff that we discussed, but also get into using a lot of the TradeView tools for reading flow for other tickers outside of futures and ETFs. But anyway, I really appreciate you watching, and I hope you all have a wonderful day.